Since the beginning of time, mankind has struggled with these two things. In every era, the proclamation of great solutions, followed quickly by the inevitable problems coming right back. Many have tried, but many have failed. And of course, I'm talking about trying to find a matching pair of socks in the morning and trying to make money when the stock market goes down. It is around the second struggle that we focus our attention here today. A great deal of fortune can be made in times of economic turmoil, and with a recession on the potential horizon, here are 5 things you need to avoid when short selling stocks if you want to become the next Michael Burry or Jim Chanos, aka the guys who shorted the housing market and Enron to the tune of hundreds of millions of dollars. Number 1, avoid short selling highly volatile stocks. This is because volatile stocks can have extremely unpredictable habits and be subject to wild price swings, which can lead to significant losses for the short seller. Let's look at a real world example. Imagine you're a grocery store owner who is running low on a specific type of bread. In order to restock your inventory quickly, you decide to borrow several loaves of bread from your competitor with the promise you're going to return them later. However, let's say in the meantime, a sudden surge in demand for this specific type of bread occurs, causing its price to skyrocket. As a result, the competitor that you borrowed the bread from initially demands that you return this bread immediately so they can turn around and sell it at a higher price. You are now forced to buy back the bread at a much higher price on the open market than you originally borrowed it for, leading you to losing money and losing your store. This is similar to what can happen with short selling highly volatile stocks. If the stock experiences a sudden surge in price, the short seller may be forced to buy back the borrowed shares at a much higher price, wiping out their account. Number 2, avoid short selling during market opening or closing. You remember the T-Rex from Jurassic Park, right? Well, think of it as the stock market and yourself, the short seller, as a visitor to the park. Just as the T-Rex is most active when it's hungry, the stock market is most active and volatile during market opening and closing. During these times, the T-Rex is unpredictable and will stop at nothing until it can eat. Just like the stock market, except the stock market is trying to eat your cash. In Jurassic Park, Dr. Grant and company quickly learned that it's important to avoid being in the T-Rex path during feeding times in order to avoid danger. Similarly, short sellers need to avoid trading during market opening or closing in order to avoid the danger of losing money due to an unpredictable and volatile market movement. By waiting until the market has had time to settle and establish a clear direction, short sellers can make more informed decisions and reduce their risk of losses. Number 3, avoid short selling low liquidity stocks. Short selling low liquidity stocks is similar to going to a Little League baseball game and trying to place a bet. When there are only a few fans watching because, hey, it's Little League, it becomes difficult for you to find somebody to bet against, just like how short sellers may struggle to find a buyer in a low liquid stock. Even if you want to bet against the team that's the clear underdog, you may not find anybody else willing to take that bet. Though you feel super confident the underdogs are going to lose, without someone to take the other side of the bet, you may not be able to profit from your prediction. In this case, you may need to offer more favorable odds in order to attract a bettor, just like how short sellers may need to offer an asking price that is lower in order to attract buyers into a low liquidity position. The lack of liquidity just means there's fewer opportunities for short sellers and bettors to exit their positions at favorable prices. This can result in losses if the prediction is incorrect, as there may be no buyers available to purchase the asset at a reasonable price. Number 4, holding short positions for too long can be a costly mistake due to margin costs, fees, and the risk of the stock price moving quickly against you, as was the case with GameStop's rise in early 2021. At the time, many hedge funds had taken significant short positions on the company, believing that its declining business model would lead to a decline in the stock price. However, a group of retail investors on Reddit's Wall Street Bets forum began buying up shares of the stock and causing its prices to soar. As the stock price continued to rise, many short sellers found themselves facing big-time account drops. In addition, margin costs and fees began to accumulate as the price of the stock rose and they were required to maintain collateral for all their short positions. hedge fund Melvin Capital reportedly lost 53% of its value in January of 2021 due to its short position in the GameStop stock. It's crucial for short sellers to monitor the market closely and adjust their positions and risk as necessary. Number 5, avoid short selling without a stop loss order. This is crucial because it can help minimize potential losses if the stock price does unexpectedly move against you. Let's say you're a vendor selling ice cream on a hot summer day. Business is good, but you have a limited supply of ice cream, so you want to sell it for a certain price to maximize your profits. However, if the weather suddenly turns rainy or cold, the demand for ice cream may shift, and you may need to lower your prices in order to sell off your remaining inventory. Similarly, when shorting a stock, it's important to have a stop loss order in place to protect against the unexpected market movements. A rainy day can happen at a moment's notice, and a stop loss order allows you to limit potential losses and protect your capital. For example, if you short a stock at $100 and set a stop loss order of $110, you will automatically sell the stock if the price reaches $110. Limiting your loss to $10 per share. Without a stop loss order in place, you may continue to hold the stock with the hopes that the price eventually recovers. Ultimately, this can result in extended losses as the price continues to rise. Just like a vendor selling ice cream should be prepared to adjust their prices based on the weather conditions, short sellers need to be prepared to protect their investments with a stop loss order in case of unexpected events. When you hear the term short selling, remember the story of the T-Rex and betting on youth baseball. And if I was able to get you to laugh or at least crack a smile, drop a like and subscribe to the channel. It would mean a heck of a lot. Plus, you'll be able to find out the full story behind what happened during GameStop's epic short squeeze in 2021 and how a group of everyday traders took down a hedge fund.